We decided to raise the three key ECB interest rates by 50 basis points and approved the transmission protection instrument. All members of the Governing Council rallied to the consensus of 50 basis points. We expect inflation to remain undesirably high for some time, owing to continued pressure from energy and food prices and pipeline pressures in the pricing chain.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London, and here's what's coming up on today's programme. We are all hawks now with a surprise hike. The ECB ends 8 years of negative rates. Christine Lagarde says surging inflation made it an easier call. Uncertainty in Rome. Italy will choose Mario Draghi's successor on September 25th as political uncertainty and economic concerns mount. And snapping the rally, Snapchat's parent misses on revenue, sending the shares plunging after hours and weighing on tech stocks and US futures today. There was some softer economic data out of the US. Then you had French and German manufacturing and services PMI. Now we have it for the Eurozone PMIs. Euro area, July manufacturing coming in. PMI 49.6, missing the forecasts. It is a pretty significant miss, 49.6. The forecasts have been for 51. Actually, I'm not going to say significant, modest miss, 49.6, forecast for 51. Euro area July services PMI, meanwhile, falling to 50.6, so a bigger miss there. Forecast were for 52. And the ECB's third quarter survey showing that euro area inflation was at 2.2%. in the longer term. We're going to get inflation data out of the Eurozone towards the end of next week. So again, it's a miss in terms of manufacturing and services across the Eurozone. That was really flagged by what we saw in Germany and France as well, and that pressured the euro. In terms of how the euro is playing out now, currently down 0.8% for the single currency. Of course, Christine Lagarde made a point of mentioning the currency and the euro as one of the reasons for that more aggressive rate hike of 50 basis points versus 25 yesterday in the press conference. In terms of the broader picture when it comes to European equities, you're seeing modest gains of about 0.1%. Technology is up despite the concerns about Snap in the US and that dwindling advertising revenue. We have some big tech names reporting next week in the US. The Bloomberg dollar index gaining 0.3%, so dollar is back again. That strength coming through, proving something of a risk-off, of course, sentiment when it comes to dollar strength. When it comes to Bitcoin, 23,117. So the gains being locked in for this week, at least for now, when it comes to that major cryptocurrency. Let's switch it on, see how things are playing out then. Across the map, we're looking at data as well that came out of the UK at around 7 a.m. UK time around retail sales coming in less badly than some expected. You're seeing gains of about 0.1%. Largely that's down to what's happening in energy. You're seeing higher oil prices, iron ore as well, and that's supporting the FTSE 100. The CAC count is range bound. You're seeing losses of 0.1% over in Germany. Italy is down by 0.2%. So the losses that we saw yesterday, of course, on that political risk, and still a little uncertainty around this tool, the anti-fragmentation TPI tool, and whether or not really it is ever going to be used in the case of Italy, the spreads and whether or not they continue to blow out. Last time I checked, about 236 over German bunds. Talking of which, the ECB, of course, doubling the expected size of its first rate hike in more than a decade, saying the economic data, and we're getting more of that today, will determine the size of future moves.
We expect inflation to remain undesirably high for some time, owing to continued pressure from energy and food prices and pipeline pressures in the pricing chain.
For more, we are joined by Bloomberg's Jana Randau then, who, of course, was monitoring all of this for us yesterday. Jana, why the last-minute change of heart then, and what does it mean for monetary policy of the ECB going forward?
Good morning. Yes, it was indeed a change of heart after policymakers flagged pretty much until the last minute that the rate hike was only going to be 25 basis points. But what made the decision easy in the end was indeed the inflation outlook, and what we've seen out of the ECB this morning. The survey of professional forecasters confirms that to an extent. Forecasters raised their long-term inflation expectations to 2.2%. It might not be much about the 2% target, but it is significant. And of course, right now inflation is running at 8.6% and rising, and that just had the ECB very concerned and expectations for faster price growth is becoming is becoming entrenched in the Eurozone. What helped the decision as well was that policymakers were able to agree on this transmission protection instrument, which will make sure that there is no bond market disruption, no unwarranted moves in parts of the Eurozone as the ECB indeed raises interest rates. Forward guidance for the next months has been axed from the statement, if you want. So the ECB said it would decide meeting by meeting on further rate steps. We expect more to come, but how big they are going to be will depend on the data.
OK, the size is going to depend on the data, and the data is coming in weak at this point. Jana, what do we know, though, about this new acronym, the TPI, whether or not it's actually going to be effective in terms of implementation, if indeed it ever comes to that?
Well, the president has been clear in saying the ECB will not hesitate to use the tool if it's necessary. But she also said that they prefer actually not to. And that, of course, is because there are legal concerns in Germany over the tool. Everybody agreed, so including the Bundesbank president. That doesn't mean that the tool won't be challenged, though. There are a few safeguards in there. For example, that the sound fiscal policies are an absolute must for the ECB to even consider purchasing bonds. And even then, that is not the only thing that the ECB wants to see and will take into account. Purchases will focus on public sector bonds, although they said private sector could also be considered if necessary. They're looking at maturities from 1 to 10 years, so slightly different from previous purchase programs, and they are accepting pari passu status on their purchases of public sector debt, which means should there ever be a debt restructuring, which of course is very, very unlikely, they accept to be treated in a similar way than other investors. But overall, they are hoping that the mere existence of such a tool will actually make sure that investors stay back, don't speculate, and will allow the ECB to keep this on the shelf.
Yeah, and some implicit messages for the next coalition government of Italy within the framing of that tool. Jana Randall, thank you. Of course, passing all of that detail for us throughout the last 24, 48 hours when it comes to the ECB and changes there from the European Central Bank. Joining me now is Deirdre Cooper, Portfolio Manager at 91. Deirdre, thanks for joining us in the studio. Happy Friday. What do you make of this shift in policy from the European Central Bank? And to what extent do we now have a little bit more clarity on central banks and how that informs your positioning?
Look, I think the ECB is in an incredibly difficult position in that it needs to tackle inflation. That's obviously become a lot more difficult post the Russian invasion. OK, we're having some technical details, Deirdre, with your microphone, so we'll get the team to check that for us. It sometimes happens. It's live TV. We'll get Deirdre back on. We'll get that microphone hooked up and her analysis as well and her takes. Let's check in on the markets as we try and get that technical issue resolved. We are seeing pressure on the euro. It's worth noting that in terms of the single currency. It's currently down 0.8%. We've had that Eurozone data in terms of PMI. You had the French and German data come in with a clear miss when it comes to manufacturing and services for the month of June. That adding to pressure on the euro. But you also have dollar strength as well. So the Bloomberg dollar index currently up 0.3%. Across these equities, very modest gains when it comes to European stocks, just 0.1%. You saw obviously a pretty significant sell-off in Italian equities yesterday, adjusting, of course, to the political changes in that country, but also the ramifications of this TPI tool. The FTSE MIB is now down 0.4%. When it comes to the US, another strong session, 3 straight days of gains in the US. But then the concern around economic data, those jobless claims, but also the factory output, little softening there when it comes to the US. And then you had the earnings of Snap, and after hours, that did weigh on the tech sector. The S&P E-mini is now looking at losses of 0.5%. It's slightly heavier in terms of the bloodletting across the tech space. NASDAQ futures pointing to losses of 0.8%. The context is that tech has seen something of a rebound in the US, but of course the concerns around advertising linked to Snap. OK, coming up, talking of technology, stocks getting knocked down in extended trading, as I said, after that disappointment around sales, advertising sales from Snap. We're going to dig in to the tech sector next. This is Bloomberg.
think the Fed is raising rates quickly, which is the tool they have, and also telling people what they're doing and being transparent. And if you start to see some adjustments being made, the rate of increase in certain areas has tipped over a little bit, but there's still work to do. In the end of the day, the Fed's toughest job is the fact that it's trying to slow down an economy which has strong employment, strong wage growth, and strong spending. And that's not the usual. That's an unusual case to see all that go on at once. And by the way, with the U.S. being one of the strongest economies in the world, and so I think they've got a tough job ahead of them. But they're using the tools they have, which is to basically raise rates and change the balance sheet. But more important, to tell people what they're doing, and you're seeing the markets adjust to that.
Brian, you have so many ways at Bank of America of looking into the U.S. economy, getting a sense of where it really is. One of the big questions is, do we think inflation has peaked? If you were asked that question, what would you say?
Well, I think it'd be different for different areas. So you're seeing in some areas the rate of increase slow down and it's starting to tip over, but you're seeing other areas, wage growth is still very strong. So I don't think it's peaked yet. And our economists would say it's peaking probably is our team. Our team basically says that the Fed will continue to raise rates. And actually, Candace Browning-Platin's team, the research team at Bank of America, has the year-end recession, which they made a call on a few weeks ago. But it's a slight recession, and a recession is not accompanied by high unemployment, which means it ought to right itself and come back out. But it's more the impact of the Fed raising rates and slowing the economy. So it's peaking is probably more appropriate than peak.
OK, inflation peaking, but not yet peaked. That is the view there of Bank of America CEO Brian Moynihan on US inflation. Now to technology, and Snapchat's parent Snap plummeting 27% after disappointing revenue raised concerns about the outlook for online advertising. Meta, Alphabet and Pinterest all sank on the news as well, as Snap sparks a second sector sell-off in 2 months. This after tech has actually performed fairly well in the last few days. Let's bring back in Deirdre Cooper then, portfolio manager at 91. Deirdre, let's get your take on the Snap earnings, but more broadly as well, what we're seeing in terms of multiple compression across the tech space, how much further there is to go, and whether there's any opportunities now, given what we've seen in terms of the compression in multiples.
So I think more broadly, we clearly saw a huge amount of multiple compression in Q1 of this year as people worried about inflation and rate increases. What we're seeing now, and I think Snap is a great example of that, is the other side, the E rather than the P in your multiple. And we're starting to see earnings revisions coming. We think we're going to see more of them. I think Snap's probably a leading indicator in terms of advertising revenues that are perhaps the early stage of the cut. Some of the others may well come later. So we're really looking for companies that have structural drivers, not cyclical. And we also really think that those structural drivers will be driven by some of the big sustainability trends that we're going to see over the next couple of years.
How do you fold that view into the broader tech space then? How much divergence do you expect to see? We have the social tech companies, and you're talking there about the potential further downside in terms of those downgrades, in terms of outlooks. Is there a case to be made that some of the other players within the tech space that focused on hardware or software, there's a bid there, there's an opportunity, and you can get exposure?
I think that's exactly right. So I think we're going to see huge divergence. There are parts of the tech space that have really strong structural drivers. I mean, things we look at are things like electrification, trends that is really moving forward. If traditional auto sales are down this year, electric car sales are up almost 100%, driven by not the US, not Europe, actually driven by China. So those are some of the structural trends we look for, and that means you're going to get a big bifurcation in performance.
How do tighter monetary conditions, we're starting to see that now from the ECB as well, joining the pack, change and adjust your views around some of these thematic themes? Does it make it more challenging?
Look, I think it actually helps the companies with structural, not cyclical drivers. As I said, we're moving towards a world where the cyclical looks really difficult. We've seen the challenges, we just talked about the challenges the ECB faced, trying to manage inflation caused by, to some extent, the war in Russia and Ukraine, really difficult politics in places like Italy. So you need to raise rates, but you also need to keep the periphery spreads in check. That's going to be a very choppy environment for European equity markets more broadly. Same in the US, interest rates are rising. It's going to be a difficult investment environment. So you need to find those structural, not cyclical drivers. OK, structural versus cyclical. What about when it comes to gas and this big dash for gas that we've had across Europe and trying to build out our own facilities, storage facilities? The Europeans even classifying gas as green. How much of a headwind is that for those structural things around decarbonisation? Does this throw that off track? So in the short term, it will certainly throw emissions reduction off track. European emissions will go up this year. Europe will have to use more coal. In the long term, though, it absolutely accelerates the drive for decarbonisation. No one imports their wind or their sun, or to some extent their electric cars or their energy efficiency. So Europe is kind of realising that the gas bridge they were planning to use to decarbonise wasn't a particularly good idea, right? As I think one of the German energy ministers said, that bridge is broken. Perhaps that bridge should have never existed. You need to go all the way to a fully decarbonised economy. And then, of course, you're also a fully energy secure economy.
What are you hearing from investors and in terms of fund flows into those areas? Is there a reticence, at least in the short term? You talked about short term versus long term. Are you seeing that in terms of their money flows?
So we're really not, actually. Investors have been incredibly supportive through this sort of time of market turmoil. There certainly has been a bit of sort of backlash. You know, is our sustainability funds going to work in an environment that isn't a low interest rate environment? And I think, like all of these areas, you sort of separate the wheat from the chaff. The sustainable funds that were tech funds in disguise will clearly do less well. Those that were really looking for long-term structural drivers that are going to outweigh cyclical, those are areas that are still attracting inflows. But more broadly, you know, flows into ESG and sustainable funds have fallen less than the rest of the market and continue to be strong.
You have an interesting call on China versus the US and Europe, and you have some preference there. Just unpack that for us. Make the case for China, given all of the concerns around geopolitics, around human rights abuses, particularly around the polysilicon, forced labour, all of those issues. How do you make the case for China at this point?
Look, the first point is no country, no company is perfect from a sustainability perspective. China, just broadly, from a fiscal and monetary policy perspective, is in a very, very different place to Europe and the US. We just talked about how challenging the environment is with rising interest rates, rising inflation. China's in a very different place. Monetary policy is getting looser. They're going to need fiscal stimulus. You know, zero COVID has been incredibly damaging to economic growth. The Chinese government just has an extraordinary number of levers at their discretion to help to offset that with stimulus. And we really believe that stimulus is going to be focused on those areas that are aligned with common prosperity, and environment is right at the top of the list. You know, you can't keep doing property. You're going to have to do some of these other areas. To the sort of, you know, to all your other points, I think those are issues that we really worry about, we're really concerned about, but not every company in China is involved in all of these areas, just like not every company in Europe is Wirecard. You know, not every company in the US is Enron.
So it's a question to follow the policy in China.
Absolutely.
Deirdre Cooper, thank you very much indeed, co-head of thematic equities, of course, portfolio manager at 91. OK, coming up, we will talk Twitter earnings ahead of their second quarter results later today during our tech wrap. That is later this hour. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Let's get the first word news now with Leanne Gerrans. Leanne.
Tom, good morning. Sources tell Bloomberg that the German government is in the final stage of a deal to bail out energy giant Uniper. The move is aimed at preventing the collapse of a linchpin in the country's energy network in the wake of Russia's move to slash gas supplies. The government is said to be looking for a stake of between 25 and 30% in a capital increase, with a price of €1.70 a share. Now, shelling by Russia has pounded a densely populated area in Ukraine's second largest city. Officials and witnesses in Kharkiv said at least 3 people were killed and about 24 others injured. The barrage hit a mosque, a medical facility and a shopping area. Police said cluster bombs hit a market. Italy will hold an early election on the 25th of September after Mario Draghi resigned as the Prime Minister. President Sergio Mattarella officially called the vote after dissolving Parliament. Polls suggest a centre-right coalition led by the Brothers of Italy could have a clear majority, but the euro area's third biggest economy now faces months of political uncertainty. Applications for US state unemployment insurance rose for a third week to the highest since November. A growing number number of companies have announced job cuts, suggesting some softening in the labour market. Data showed initial unemployment claims increased by 7,000 to 251,000 in the week ending July the 16th, higher than analysts forecast. And right here in the UK, the latest polling shows Foreign Secretary Liz Truss has extended her lead over the former Chancellor Rishi Sunak in the race to be the country's next Prime Minister. A YouGov survey of 730 Conservative Party members gave Truss a commanding 24-point advantage over her rival. Sunak has won all 5 rounds of voting among Tory MPs. Now the party's wider grassroots membership will choose between him and Truss, and the winner will be announced on the 5th of September. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Leanne, thank you. OK, coming up, Norsk Hydro will return as much as 5 billion kroner to shareholders. We'll speak to the CFO. This is Bloomberg. We are all hawks now. With a surprise hike, the ECB ends 8 years of negative rates. Christine Lagarde says surging inflation made it an easy call. Uncertainty in Rome. Italy will choose Mario Draghi's successor on September the 25th as political uncertainty and economic concerns mount. Snapping the rally, Snapchat's parent misses on revenue, sending the shares plunging after hours and weighing on Asia tech stocks and US futures today. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Now to the earnings story. An aluminium maker, Norsk Hydro, will return as much as 5 billion kroner to shareholders. That's after reporting a record profit from its primary metal and extrusion business. Joining me now is the company's CFO, Pal Kildemo. Pal, congratulations on the results. You're returning money to shareholders, dividends and buybacks. Is this peak profitability for the company?
Well, it's the 5th consecutive record quarter we have as Norsk Hydro. And when you look at the outlook into the coming quarter, it does look somewhat more uncertain. Aluminium prices have come down from the highest levels on record, I guess, since 1987. Fell by more than $1,000 in the quarter. And we've also seen that alumina prices have traded somewhat down, whereas raw material costs are still holding somewhat up. Where we are benefiting a lot as a company is on the energy side, where markets are tight. But adding that all together should result in a lower Q3 than the second quarter.
OK, well, there's a lot to go through there. Let's start with the demand picture then, Pal, if we can. Are you starting to see softness in Europe? And if so, which sectors?
We are. And when you look at our full year demand estimates, then it has come somewhat down. We were earlier expecting an undersupply for primary aluminium for the year as a whole. Now it's more balanced. And the sectors where demand has been stronger than expected is on the building and construction side, but where there's been weaker than expected has been on the automotive side. Supply chain issues and the continued time to get chips, etc., has still impacted Q2. But if you look into Q3, then that situation is reversing somewhat. There we see building and construction pulling somewhat back, whereas automotive is hopefully, and as it looks, gaining momentum, which benefits a company like ourselves that is automotive exposed. And another area where demand is very strong these days is still for greener aluminium. We increased our sales 89% quarter over quarter for green aluminium.
OK, so very strong demand for green aluminium. An interesting breakdown there of the different sectors and how that demand picture is shaping up. When it comes to energy then, Pal, you touched on this. Just how bad do you think it can get? I mean, obviously smelters are major pullers in terms of major consumers, major users of electricity and energy. How bad does it get in the winter?
That's a very good question. And that is what could really balance what we're seeing on the demand side when you're looking at Europe as a whole. So far this year, or this year and last year, around 900,000 tons of smelter capacity has been taken out due to the very high energy prices in Europe, but also some in the US. we still see around 1 million tonnes at risk of having to curtail as their existing power contracts or hedges expire in the coming period. So that is huge for the European aluminium industry, which has become smaller and smaller over the years. For Norway and for potentially Iceland also, where there is also a lot of aluminium production capacity, there are more long-term power contracts at the attractive price, which should be able to maintain the production there.
And you've done some hedging around pricing. What is your view, given everything that you've just talked about in terms of demand and supply, the input costs, in terms of where pricing ends up towards the end of the year? Do you see further softening of pricing at this point?
That's a very good question. And at the end of the day, we don't really know. And that's why we have also hedged a quarter of our portfolio. I would be happy for us to lose money on those hedges, because that means that we make money on the rest of the portfolio. But in uncertain markets, having something extra on the downside is usually worth more than having something less on the upside. There are two things moving against each other. It's the demand on one side. If demand continues to weaken, as it looks is happening now, then all else equal, the price typically trends down. But the issue with the price now is that you're pricing well into the cost curve. You're now pricing at the 65 percentile of the cost curve, which means that 35% of smelters are loss-making. So it depends on how long time it takes for those type of smelters to curtail production before you get prices moving back up again. Because energy prices and input factors are still high.
They are still high, Pal. Do you have any sense, any clarity, the data that you're seeing around when you think those input prices start to moderate?
Yeah, if you look at our two biggest business areas with these bauxite and alumina and aluminium metal, then our guidance on the cost into the next quarter is quite limited compared to what you've seen from Q4 to Q1 to Q1 to Q2. We're actually guiding for somewhat lower input cost in aluminium metal, primarily driven by falling alumina prices. So if not falling, we have seen some flattening on most of the raw material prices. And then we will see through Q3 how that further develops. But they are also exposed to many of the same demand drivers that we now see impacting the aluminium market negatively.
And Pal, before we let you go, you have a plant in Slovakia. You've been cutting production there. Ultimately, were you looking at a potential closure next year of that plant?
Well, if you look at Slovakia, the power market, with the prices that you're seeing now and the LME prices, that would be running at a large cash loss into 2023. So if we don't get anything on the regulatory side, or if power prices don't fall or LME prices don't increase, then it looks challenging for 2023 for Slovakia.
OK, Norsk Hydro CFO Pal Kildermo, thank you very much on those results that beat and a return to shareholders in terms of buybacks and increase in the dividend. Thank you for your take. OK, let's recap some data then coming through. We had the Eurozone data in terms of PMI, France and Germany as well. Here now we have the UK July manufacturing PMI coming in, and it's a beat for the UK, 52.2. The forecast was for 52. Services PMI, meanwhile, falling to 53.3. Still, of course, comfortably in expansionary territory. The forecast had been for 53. So the data out of the UK diverging with what we're seeing in the Eurozone, and it's a beat there for the UK when it comes to manufacturing and services PMI. Also, a line crossing on Uniper. The German Chancellor, Olaf Scholz, will speak on the question of Uniper and that bailout, of course, that we know is being worked up in Berlin at noon in Berlin. So we'll bring you the details of that, of course, as we await what will happen in terms of that response from Berlin, in terms of the bailout of course, that major utility company with the gas flows out of Russia, part of the mix there. Coming up, UK retail sales fell less than expected in June as food spending jumps. The Jubilee boost. We look at the economic picture of the UK next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Now, soaring food and fuel prices and rising interest rates have kept UK consumer confidence at a 48 5-year low. According to the latest monthly research by GfK, almost all of the measure that make up the confidence index all of the measures remain in deep negative territory. Bloomberg's Lizzie Burden has been looking at the details, and of course we also had the manufacturing and services PMI as well. Let's start with retail sales, Lizzie, and your take on what's been happening there.
Yeah, it's slightly better than expected, but it's a slight drop from the previous month. And so what it reflects is the cost of living crisis weighing on people. As you saw from that GfK survey that you mentioned, people are severely depressed, says GfK, about their outlook. But at the same time, we aren't at peak inflation yet, and you had that boost from the Jubilee bank holiday on food sales offsetting the rest. What it means for the BOE, I don't think it moves the dial really. We've already had the inflation jobs data this week, and you've seen from the ECB a 50 basis point hike, so it looks like the Bank of England will do the same. You mentioned about the PMIs. It seems a little out of step again with that GfK survey, but don't forget the PMI doesn't cover all the industries, so this is actually what our economists were expecting.
Yeah, so a beat there. I mean, just broadly, in terms of the data today out of the UK, it's been a beat in terms of retail sales, less bad than expected, manufacturing services coming in better than expected on PMI, but of course, where there's important caveats, and as you say, it probably doesn't change the calculus of the Bank of England. What about the politics of the UK, where things stand in terms of Rishi Sunak versus Liz Truss?
Well, as expected, Liz Truss is in the lead because now it's the grassroots members who are voting. In the latest YouGov poll, she's 24 points ahead. The debate's still very much focusing on the economics of it all. They're trying to outdo each other on who is the heir to Margaret Thatcher. Aside from that, well, I mean, investors really are concerned about Liz Truss's stance, not just on the Bank of England, but also on Brexit and tax cuts, I'd say in that order. But really, I think in the TV debates that are going to come up, there are two to come. It will focus on character and competence. And I have to say, every economist I've ever spoken to at the Treasury who briefed Rishi Sunak when he was Chancellor says that he knew the detail before they even told him.
Very interesting. So watching for those debates. I think the first one, correct me if I'm wrong, is on Monday evening. So watching that and see if he can move the dial. Rishi Sunak, he is lagging in the polls.
He's got a lot of ground to catch up.
He's got a lot of ground to catch up. Lizzie Burden, thank you, of course, on the economic data and the politics, of course, of the UK. Now we are joined by Penny Hughes, chair of Riverstone. It's a later living property developer backed by Goldman Sachs. Penny has served on the boards of several leading consumer brands, including The Body Shop, Vodafone, Morrison's, and most notably Coca-Cola as well. In 2020, she oversaw the sale of IQ student accommodation to Blackstone for more than £4.5 billion, which I believe is the biggest deal of its time. Penny, thank you for coming into the studio. Quite the portfolio, quite the CV you have there, the resume. Let's start with Riverstone then, which is kind of the primary focus of your energies at the moment. What are the expectations around the opportunities for this later life accommodation? It's something that we see predominantly in, I'm thinking of Florida in the US, but also Australia. Can it work here? Is it working? And where are you looking to expand?
Oh, right. That's right, Tom. Well done. So in New Zealand, in Australia, more than 5% of the over 65s will live in some kind of retirement community. In the UK, it's less than a tenth of that. And yet we know that the over 65s is the highest growth population. So we're expecting over 75s to double in the next 30 years. And really, we have very little appropriate housing options for them. And so this is an emerging asset class. Riverstone is focused in London. There are other companies focused outside of London too. And really, it is an amazing opportunity to provide the right sort of housing options for later living.
OK, so that's the demand. What are the challenges in this space, whether it's finding the property, getting the funding, and indeed labour costs as well, the staffing?
Yes, there are some challenges. One of the challenges is actually in planning. So only 1 in 4 boroughs have actually allocated a quota for later living new housing. And so that's one of the things that we'd be talking to government about in terms of improving the planning sort of framework for these developments. At Riverstone, we've just opened in Kensington. We're due to open in Fulham later this year. We have a site in Hampstead and an intention to roll out to 10 properties in London. And so we're a property developer, but obviously we're also an operator. So yes, hiring people in London, is challenging. But if you've got something new like we have and something really quite special, then we've attracted some really super talent.
Has Brexit made it more difficult? Have you had to raise wages more than maybe you would have expected?
There are wage increases, and I see that across my portfolio. And obviously, COVID in particular was difficult for this sector because this was a community that was particularly impacted by COVID. So now we're largely through COVID. That is, and I think what COVID has probably demonstrated to us that being part of a community and having a set of services on site actually helped the healthcare of this older population. And so I think COVID has probably meant that the later living opportunity is even greater than it was before. So we're very optimistic. Obviously, we've opened Kensington, we've started selling, we've started having residents come into the property. There are beautiful services on site, there's leisure facilities, there's healthcare facilities. And so it is a very attractive proposition.
I want to get your views on what's happening with the politics of the UK. We had SoftBank and Arm. We were hoping, of course, this capital markets, you're not inexperienced when it comes to the capital markets as well. We were hoping, of course, the UK was hoping to attract Arm to list in the UK, in London. It looks like that may not happen now, and SoftBank flagged the political risk. Are you seeing that bubble through now amongst the business people that you're talking to when it comes to that commitment to invest in the UK?
So at Riverstone and indeed other later living, there has been a significant interest in the sector because it is an emerging asset class. You mentioned earlier that I was chair of IQSA student accommodation. This really is the next platform property asset after student accommodation. And so there has been significant inflow of capital and it has to be long-term patient capital because these are properties that take, a few years to build and a few years to sell and therefore a few years to see true value from. But if you're asking me, are the equity and debt markets difficult right now, then the answer is absolutely yes. But obviously at Riverstone, we're backed by Goldman Sachs and therefore we're able to continue with the business
So I'm asking
plan.
you to step away from Riverstone,
Yes.
drawing on all of the experience that you have and getting a sense as whether UK Inc. is becoming less attractive now because of the politics and the uncertainty.
Uncertainty is never good for business. And so the sooner that we can have certainty, the better. Obviously, the economic backdrop is difficult. Cost of living crisis will make it difficult for consumer businesses. But that's when leadership is needed.
Are you preparing and bracing for a recession here in the UK?
I think we will find that there is a slowdown. But again, with my Riverstone hat on, that's not impacting. But with some of the other things that I do, I can see something of a slowdown. But it is up to business leaders as well as political leaders to continue to really adapt and be agile to the circumstances that you find yourself in. And so I'm careful, but still optimistic.
Careful, but still optimistic. We'll leave it on that note. Thank you very much indeed for coming to the studio this Friday. Penny Hughes, of course, chair of Riverstone. OK, let's get your Bloomberg Business Flash now with Leanne Gerrans. Leanne.
Hi, Tom. Sources tell Bloomberg that the German government is in the final stage of a deal to bail out energy giant Uniper. The move is aimed at preventing the collapse of a linchpin in the country's energy network in the wake of Russia's moves to slash gas supplies. The government is said to be looking for a stake of between 25% and 30% in a capital increase, with a nominal price of €1.70 per share. One of Elon Musk's top lieutenants is said to be under internal investigation for his role in a plan to purchase hard-to-get construction materials. Ahmed Afshar is the executive running Tesla's Texas factory. Sources have told Bloomberg that Tesla plans to be part ways with Afshar, but terms of his exit are still being worked out. Some employees have already been fired over that investigation. Amazon is starting the delivery of packages to US customers using the first of many 100,000 electric vans built by Rivian. Amazon expects to have the vehicles deployed across more than 100 cities by the end of the year. Amazon has delivered 430,000 packages using Rivian pre-production vans since 2021. Speaking on Bloomberg TV, the company's CEO confirmed plans to cut 5% on non-manufacturing roles.
These are some of the hardest decisions a leader has to take in running a business, and certainly we're trying to be as intentional and as thoughtful in terms of what that means for the business, what that means for the individuals as we work through that process. But as you said, this doesn't impact our manufacturing teams. This is really more heavily in some other aspects of the business.
And Mattel, who makes Barbies, says second quarter margins declined due to inflation, higher supply chain costs and royalty expenses. Gross margins shrunk to 44.4% from 47.5% just a year earlier. However, profit and sales were a beat, driven by demand for action figures. The CEO says he still expects growth in the second half and also next year. And that's your Bloomberg Business Flash. Tom, I was told boys' toys, not just Barbies.
Boys' toys, not just Barbies. We try and keep Barbies out of our house with our daughter, but it doesn't work. She just loves those, loves the dresses and the dolls and, you know, taking heads off and stuff like that. Maybe that points to my my daughter's dark intentions. Anyway, moving on. Coming up, technology stocks get knocked down in extended trading after Snap's sales disappoint. Tech in focus next. This is Bloomberg. Welcome back. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Now, Snapchat's parent, Snap, plummeted 27% after disappointing revenue raised concerns about the outlook for online advertising. Meta, Alphabet and Pinterest also sank on the news as Snap sparks a second sector sell-off in just 2 months. Joining us now is Alex Webb from Bloomberg Quick Take. Alex, what do the Snap results mean for the broader tech sector?
Well, we've been talking for a while about how the first companies that get hit in an economic downturn are often the ones exposed to marketing, and because that's the first thing that companies cut. They cut their marketing and advertising budgets. Now, that clearly has implications for Google, Alphabet, Meta, and Facebook, and slightly further down the pile are, of course, Twitter, Snap, Pinterest, and these others. The thing is, with Snap, it was trading, certainly before these earnings, at an incredibly punchy multiple, 145 times forward earnings. That doesn't leave much wiggle room for error, and so if it shows any flaws, which it clearly did, particularly in the current quarter, where it says revenue is about flat with the year earlier. So it's not showing the growth on which it's valued. It's valued as a growth stock. That's why it's being punished. OK, remarkable PE, despite the drawdown that we've seen. Looking ahead to Twitter, what are you looking for? Any comment on the Musk situation will be interesting. It seems highly unlikely they will say much because there is this court case, and they'll probably use that as some sort of cover for not doing anything. But also, what impact genuinely has the Musk situation had on its business? Or is that actually just structural? They're structural issues that they haven't worked on. I.e., is there a solution coming down the pipe, coming out of the Musk situation, which will let them continue to grow apace, or are there broader issues which haven't been dealt with? And of course, if they win that court case, and that's a big if, they get about $1 billion from Elon Musk. No, they will get $1 billion either way. The $1 billion is the breakup fee. If they get a settlement of maybe 5, 8, some have even said $10 billion, and that if they were to get $8 billion, that would be 4 times the cumulative free cash flow in their history as a public company. Very interesting. Looking ahead to Twitter earnings, Alex Webb from Bloomberg Quick Take, of course, breaking down what to watch for within tech. Now, Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller and Kailey Leinz in New York, and of course, Anne Edwards here in London. Your markets here in Europe gaining 0.4%. Future stateside looking to losses of 0.3 on the S&P E-minis. Nasdaq futures currently down 0.6%. The euro under pressure after some weaker than expected data, down 0.7% at 101. Stay with us. This is Bloomberg.
When are you ever going to see growth and inflation higher than it is right now?
That's the inflation picture in Europe and globally. It just forces central banks to front load.
We put a 50-50 chance of recession. Most of the clients I speak to think that it's much higher than that.
We're positioned for, as we say, a little R recession.
The recessionary talk, the doom and gloom scenarios are becoming a bit more consensus.
This is Bloomberg Surveillance Early Edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London.
5 a.m. in New York and 5 p.m. in Hong Kong. Our top stories today. Social media giants get hammered. They lose almost $47 billion in market value after disappointing revenues at Snapchat's parent raises concerns about online advertising. Central banks are hiking fast to make up for lost time. Does the speed of tightening make recession the price to pay for beating inflation? We will have analysis. And Joe Biden becomes a symbol of the fight against COVID. The president is being isolated after testing positive and experiencing mild symptoms. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz over in New York. Kailey and Matt, good morning to you from London. And Kailey, we seem to be separated by the Atlantic in terms of stock market performance today. We don't have such heavy weighting to tech here in Europe, which perhaps on this occasion helps.
Yeah, absolutely. And it'll definitely be an influencing factor next week when we have all of the mega caps reporting. Certainly Snap not sending a great signal for the likes of Meta and Alphabet. And we'll have more on that in just a moment. I do want to quickly run through what we saw in Asia overnight, because honestly, in equities, it was a relatively muted session, just very small gains across most of the major benchmarks. The MSCI Asia Pacific Index up by about 0.2%. Where the more dramatic action is today is really in the bond market. That is a story globally. Yields coming in as economic data is disappointing. First, you had jobless claims, the Philly Fed index in the U.S. Then you had those PMIs out of Europe today. So yields are moving lower across the board. And that was definitely true in Australia and New Zealand. The 10-year Aussie yield down 13 basis points. The 5-year in New Zealand down about 9 basis points overnight. And finally, I would just note that we did get inflation data out of Japan, 2.2% on consumer prices in the month of June. That, of course, is above the BOJ's target of 2%. And yet Kuroda says he has no intention of hiking anytime soon. So that is keeping continued pressure on the yen, which right now is trading at 137.55 to the dollar. But of course, literally everything in G10 is weaker against the U.S. dollar this morning, Matt.
All right, let's take a look at what's going on here in the U.S. S&P futures down a little bit. Of course, that Snap news that Kailey's already spoken about is going to weigh heavily on U.S. markets because of the tech weighting that Anna was talking about. We also have investors buying 10-year debt. That pushes the yield down now 6 basis points, so a pretty big drop to 281.42. It's been a while since we've seen it down at this level. And NYMEX crude not doing a lot. So in terms of commodities, crude is not it. But after we look at Bitcoin, $23,305. I want to highlight a couple of commodities that Anna brought to my attention. Wheat and corn trading on the CBT, both coming down pretty substantially, and the volume is huge. I'm talking about 50, 60, 70% more than we normally see at this time. That's because we're expecting to see an agreement signed today that will allow the Ukraine to resume its shipments of grains through the Black Sea. So, Anna, that should put some more downward pressure on these prices.
Yeah, we saw that starting last night, didn't we, in the US session? Carrying on now, will we get any material commitment in that regard? Matt, I suppose is the question. And how about the demining efforts that would involve? A lot of questions, but really worth keeping an eye on those commodities with that conversation taking place in Turkey today. Here on the European equity markets, we're actually losing a little bit of steam. So as I started the programme saying we were moving in different directions across the Atlantic, well, not so much now. European stocks fading just a little. Certainly the UK market now pretty flat. We have very modest gains coming through in France and in Germany. It seems we're buying stocks and we're also buying bonds today. Let me show you what's going on with FX markets as well, because we've had a lot of data out from Europe earlier on. Kailey referenced this, and this certainly has added to weakness in the euro. So the euro down by 0.7%, a day after we got that big hike, and further details about the transmission tool from the ECB. A day after that, we then are reminded of the growth threats ahead. We got French manufacturing PMI, which is now in contraction, German manufacturing and also services PMI, both in contraction. So really headlining the threats to the Eurozone economy still to come. The pound, it seemed that some in the market were downgrading their expectations for how much of a hike we'll get from the Bank of England earlier on this morning, and that led to some weakness in the pound. We've paired those losses a little bit on the PMI data out of the UK, actually coming in a little bit better than expected and in growth territory. I put in the German 5-year yield in this case. We've seen a lot of buying, as I said, in sovereign debt as a result of the nervousness around the data, and that is reflected there in the German 5-year. And Uniper, also one to watch then, Kailey, as we go through the session, up by 5.7% today. It's down, though, by 76% or so year to date. This gas business over in Germany in talks with the government, and we're expecting to hear from Olaf Scholz in around an hour's time more details of what they intend.
All right, so that is definitely something we'll be looking forward to later this morning. And there is plenty more ahead today, including at 6:30 a.m. New York time, the rate decision out of Russia. We're expecting them to ease again, but this time economists only expect easing by about 50 basis points. Then tech earnings will continue with Twitter reporting at 8 a.m. New York time. In addition to the drama around its deal with Elon Musk, how much does it fall victim to those same advertising headwinds as Snap did? And finally, we'll get U.S. PMI data, the preliminary read for July at 9:45 a.m. New York time. Of course, Europe not setting a great tone with their data ahead of those numbers, Matt.
All right, we'll definitely be watching for all of that today. Let's get back to the Snap story. Plummeting after disappointing revenue raised concerns about online advertising. Meta, Alphabet, and Twitter all falling on the news. It's the second time in 2 months that Snap sparked a major tech sell-off. And to me, it seems like it's just the disappointments from this company that remind me it still exists. Bloomberg's Alex Webb joins us for more. Alex, why does Snapchat have such a big influence on real markets?
I feel this is going to come across like a dig at you, Matt. I don't mean it to be, but it's because their audience and their user base is young. And of course, those are the people that the advertisers want to tackle. That's the really valuable demographic, your sort of 18 to 25-year-olds. And so if you are seeing a tampering back in the spending on advertising for that core demo, then the implications for the older demos is even more potentially drastic. Of course, Snap is smaller, less resilient perhaps than Facebook and Google, which in some ways, if you're in the market for almost any consumer product, you've got to be advertising on those platforms. But because Snap, of course, trades at a huge multiple, certainly before these earnings, 145 times forward earnings, it means that any wrinkle in the numbers is going to be punished, and this is what's happened here.
OK, so there's the wrinkle, perhaps coming in the shape of TikTok competition as well, something that some are talking about. Let me ask you about Twitter and what we expect to see there. Again, we could see competition, but also internal distraction because of all that has been going on with Twitter.
Yeah, so if you have two problems at Snapchat, namely the Apple crackdown on online advertising and the economic environment, at Twitter, you have a third factor, which is the Musk factor, and whether it has been actually in some sort of stasis over the past 6 months or so, 5 months or so, because of that. Now, if they are trying to say, well, we've not been able to do as much because of this, then we probably need to see a plan for how they come out of it. What are the big strategic steps they're going to be taking to start delivering the pace of growth that investors are expecting? We've seen their valuation obviously come down significantly in the past few weeks. They were valued at 50 times forward earnings, then they're valued at 32 times forward earnings. They're a long way short of that $54 a share that Elon Musk offered. Is there a path to get back to it? That's what investors want to hear.
All right, Bloomberg's Alex Webb, thank you so much for your insight on all things tech. Now, after underestimating the worst inflation outbreak in decades, central banks are now driving their economies toward recession in order to tame prices. The stark outlook is stoking fears that policymakers will end up overreaching as they push ahead with aggressive interest rate hikes. And on that note, we're just getting some headlines out of the ECB's Peter Casimir saying that the September rate hike may be 25 basis points or 50 basis points. Of course, the ECB hiked 50 yesterday, brought rates to zero, ending 8 years of negative rates. He went on to say that data convinced him to start hiking with a bang, and the ECB move is beginning a series of similar steps. But you have to put that in contrast with the really weak PMI data we got out overnight or this morning from Europe, as Anna was detailing. Enda Curran, our chief Asia economics correspondent, joins us now. So Enda, this morning, a perfect example of the weakness that not just the ECB, but really central banks across the board are hiking into.
Yeah, right across the world. So the pace of these emergency rate hikes, Kailey, are now starting to unsettle investors. They're saying the path to a soft landing really is getting very narrow. Indeed, we had a Bank of America investor survey this week pointing out that investor confidence in policymakers pulling off a soft landing has collapsed. We have predictions of a global recession in and around 50-odd%. And like you mentioned, we're getting gauges on activity right around the world, be it Europe, be it Japan, be it China, and of course parts of the US that show a slowdown is underway. And the feeling is now that perhaps after missing the inflation build-up, central banks are going too hard. We saw what the ECB did yesterday. Same for the South African Central Bank. We're going into the Fed, going by 75 basis points next week. When you put it all together, investors are concerned that by the end of the year, they may have done a lot of damage to growth.
Is it going to hit harder in some places than others, Enda? I mean, clearly it is. Do we know where it's going to hit harder?
We're already seeing it surface in places like New Zealand, for example. Matt, there's a big hit to house prices underway there. I think it will show up in those economies that have been moving fastest and most aggressive early on. People are keeping an eye on Canada, for example, and of course there's recession talk in Europe. But I think the big question is about just the extent and the pace of these interest rate hikes. I don't think anybody's arguing that central banks don't have to respond now, but you are even getting officials like Esther George from the Kansas Fed recently saying, look, the pace needs to be kept an eye on because we don't quite know where all of this is going to wash up. So as I say, this story has been brought into sharp relief by the ECB's move yesterday. We're heading to the Fed next week with that 75 basis point move. It's all of it combined is only stoking talk of a global recession.
All right, Bloomberg's Enda Curran in Hong Kong, thank you so much. Now let's head over to Washington. The White House is confident that President Biden will avoid the worst of COVID-19 after he tested positive yesterday, thanks to vaccines and a therapeutic drug. The president is experiencing mild symptoms and has begun taking Pfizer's Paxlovid. Joe Matthew, Bloomberg Washington correspondent, joins us now in D.C. for more. So, Joe, obviously we're in a very different moment now than we were when President Trump tested positive for COVID back in October of 2020. Do we have any update on the president's condition this morning?
Only that he's isolating inside the White House residence, and the White House was deliberate yesterday, Kailey, to remind us that he was working. They kicked out an image of him, a photograph of him behind the desk. He also issued a video that he recorded on the balcony overlooking the South Lawn, and he looked healthy, said that he was feeling okay, and said keep the faith, all the stuff that you need to do to reassure the world as the president of the United States that things are continuing. But I'll tell you, there's a massive process underway right now at the White House to try to find close contacts with the president, remembering that he just did quite a bit of traveling. This is something a lot of people can relate with. It was 4 or 5 days on the road to the Middle East, Israel, Saudi Arabia. Then he came back to the U.S. and went to Massachusetts for an event just a couple of days ago. That's a lot of people in a lot of places that the White House will need to follow up with here. In the meantime, the messaging has been remarkable. Remembering it was 2 4th of Julys ago that the president said this country was close to declaring its independence from COVID. Yesterday, in the White House briefing room, Karine Jean-Pierre, the press secretary, said, we knew that this would happen eventually, which is not something we'd heard from the White House before. And they also said that everyone at some point should expect to get COVID. That is a very different message than we heard from this administration when the president was first elected.
All right, very interesting stuff. Going from the current president to the previous one, Trump insiders told the January 6th committee the former president ignored pleas to call off the mob storming the U.S. Capitol. The panel held a televised primetime hearing again last night. Republican Representative Adam Kinzinger, a member of the committee, spoke.
President Trump did not fail to act during the 187 minutes between leaving the ellipse and telling the mob to go home. He chose not to act.
All right, so clearly he's in the minority in terms of people in his party that are critical of the president. But what do we expect to happen out of all this?
It's a great question. Look, we thought, Matt, that would be the finale last night. And the committee has now said that because much more evidence and many more witnesses are coming forward, I think Benny Thompson referred to it as the dam finally breaking. They're now allowing for further hearings. That's going to mean a delayed final report. So we'll probably have an interim report at some point. But it's unclear exactly what happens, Matt, if Republicans take control of the House, as many expect and are predicting in November. If the work is not done by then, the Republican majority could simply dissolve this committee and then turn around and investigate them, which is what a lot of people expect to happen. The fact of the matter is, though, we did get a TikTok last night. The president of the United States did spend that 187 minutes, for the most part, in the dining room off of the Oval Office, watching all of this on TV.
All right, Bloomberg's Joe Matthew, thank you for joining us on TV this morning. And of course, you can also listen to Joe on radio every weekday on his program Sound On. That's at 5 p.m. Eastern on Bloomberg Radio. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. A lot of them related to earnings, or really most all of them. Mattel is one of them. It actually beat on profit, but its margins narrowed in the second quarter due to inflationary pressures and supply chain issues. And the company's CEO even saying they're starting to see demand waning for more expensive products like the Barbie Dream House, which I'm sure Matt's daughter is going to be begging for in a couple of years. It's about $200. People might not be willing to shell out that much for toys. That stock down about 1.5%. It's an even bigger move lower for Seagate, the biggest maker of computer hard drives. It missed expectations, citing big macroeconomic headwinds. It's down 11%, and it's a similar move for Intuitive Surgical. Really rare miss on both the top and bottom line. Actually, the revenue miss was the biggest on a percentage basis, going all the way back to 2013. That stock is down almost 12%, in fact, in early hours, Anna.
Good to see, with all that changes, that the dream house is not one of those things, Kailey. Right, we will come back and have a conversation about these markets. Ben Emons joins us, Managing Director at Medley Global Advisors. We'll certainly dedicate part of the conversation to the weakening data picture in the US yesterday and in Europe today, and Snap's slumping sales sparking another tech sell-off. We will discuss all of that with Rob Kniaz, Hoxton Ventures founding partner and a former Google product manager. What does Snap tell us about the rest of the ad spend universe in the US? Plus, the sinking gold town. How one town in Ecuador is being consumed by sinkholes caused by illegal mining. Read more of today's Big Take story on Bloomberg.com or by typing NI Big Take into your Bloomberg terminal. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards with us out of London. Now, we had seen the S&P rally back to basically 4,000 from less than 3,800 this week. Kailey Gupta joins us right now to talk about how Snap is going to break that rally.
Snap the rally.
It's gonna. I didn't want to say that, but
You
yes.
gotta go with the fun.
So, Kriti, and we saw a lot of breadth also a couple of days ago. We haven't seen that. We didn't see that yesterday again. But what does this rally look like to you?
Well, we saw it earlier in the session where you did have, I think, every sector except, I want to say, utilities and energy that were in the red. So that is still a fairly broad rally. So not all 11 sectors in the green, but it is there. I think what's interesting here is that, yes, we've snapped the rally. We're going to giggle every time I hear that now today. But futures are down only 0.2%. This isn't a market that's panicking necessarily on headlines that I think are fairly panic worthy, which is interesting. You had the same hiring story come out of Snapchat, guidance suspended in their third quarter. This is a lot to digest at a time when their daily monthly users are actually higher and beat estimates. So their fundamentals that they're usually judged by are strong, but then they're talking about this macroeconomic kind of headwind, and that's where you start to get the fears going into the tech space. But even with that, futures only down 0.2%. So
okay, so maybe you're not seeing stocks in pure panic mode, but it seems like bond investors are starting to panic about the economy a little bit because we've had a series of disappointing data points, both in the U.S. and in Europe this morning, and there's a massive rally coming in the bond market.
Oh, massive. And I think this is huge. It's getting very far away from that 3% level that's kind of been hovering around for the last couple of days. And I think this is crucial because this is coming off of the PMI data that we got out of Germany specifically this morning. The UK PMIs, though, coming in still strong. They're still in expansionary territory, so that is good news. But to your point, Kailey, you are starting to see that dip into, or dip in yields, I should say, hopping back into the bond market. I think what's interesting here is that you are starting to see it happen in the U.S. market as well, but it's not necessarily a U.S. recessionary story. In fact, I think it's more, obviously, it's going to be a European story, but we've been talking about that for a while. A couple months ago, we were talking about how European recession is almost a foregone case. The idea it's going to come, and it might actually be isolated to the continent. And I think what's different this time around is that there is that contagion effect, and that's, I think, where you're seeing the relationship between what's happening in the bonds market, for example, to the U.S. Treasury market.
Yeah, and it's interesting, Kriti, that negative data, as Kailey points out, led to selling of the euro, led to investors piling into government debt, but also buying stocks more enthusiastically, as if there is perhaps the start of that bad news is good news thought process that you get when investors start to think about whether central banks might pause their hiking cycle, as mad as that sounds, given they only just started yesterday.
Well, dare I say that there is no alternative might actually come back, the whole entire TINA concept, or even the Fed put, for example. I mean, if you're starting to price in rate cuts, you're starting to price in this idea that the Federal Reserve might not be as hawkish in going into 2023 as they are right now, that is a reason to buy. And I think to your point on currencies, look, you're hiking and the euro is not appreciating. That signals that there's a problem there.
Yeah, the euro down 0.7% this morning. Kriti, thanks very much. Bloomberg's Kriti Gupta. And for more market analysis, check out MLIV Go on your Bloomberg terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now, keeping you up to date with news from around the world, here's the first word. In the UK, a new poll shows Foreign Secretary Liz Truss extending her lead over former Chancellor Rishi Sunak in the race to be the next prime minister. According to a YouGov survey of Conservative Party members, 62% said they would vote for Truss and 38% went for Sunak. An earlier poll this week had Truss leading by 19 points. Turkey says an agreement to allow shipments of Ukraine's grain will be signed in Istanbul today. Ukraine, Russia, and the UN will sign the accord. Ukraine's grain shipments have been largely stalled as its ports have been blocked since the Russian invasion. That's led to predictions of an increase in world hunger. And one of Elon Musk's top executives at Tesla is the subject of an internal investigation. Bloomberg's learned that Omid Afshar, who runs the company's Texas factory, is being looked at for his role in a plan to buy hard-to-get construction materials. Tesla has already fired some employees in connection with the matter. The terms of Afshar's departure are still being worked out. Coming up, we'll get back to the markets as we see a big rally in bonds off the back of disappointing economic data. Ben Emons, managing director at Medley Global Advisors, joins us to give us his take on the global economy and the central banks of the world responding. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Social media giants get hammered. They lose almost $47 billion in market value after disappointing revenues at Snapchat's parent raised concerns about online advertising. Snap sees a major slowdown in the ad industry. Central banks are hiking fast to make up for lost time. Does the speed of tightening make recession the price to pay for beating inflation? We will ask Ben Emons of Medley Global Advisors. And Joe Biden becomes a symbol in the fight against COVID. The president is being isolated after testing positive and experiencing mild symptoms. The White House is confident that he will avoid the worst of the illness thanks to vaccines and a therapeutic drug. I'm Anna Edwards in London, Matt Miller and Kailey Leinz in New York. Matt, clearly, I'm sure that the president's battle with COVID, mild as it might be, will be one of the talking points today through the session, although COVID not the threat it was in pre-vaccinated societies, of course. From a market perspective, we're dealing with a lot of negative news flow, US data and European data.
Yeah, I feel like we're kind of over the COVID thing. The president got it. It's no big deal. He's still doing his work. In terms of markets, we have the S&P futures down right now, but 39.90. So we're getting closer on the S&P to 4,000. It's been really an incredible week, although as Kriti Gupta was just saying, we're not seeing the breadth anymore that we were seeing just a couple of sessions ago. Nonetheless, seems like it has been a rally that held with conviction. Snap may break that, and we'll see in just about 4 hours from now. The 10-year yield coming down really drastically. Kailey pointed this out earlier. I mean, we were around 3% pretty much the last couple of weeks and have come off 20 basis points in the last few sessions. So that's a real concern. NYMEX crude, not a real concern. Holding under $100, 96.18. It's down another 17 cents this morning. And Bitcoin is actually up 1.6%. A viewer pointed this out. It's not from midnight. We measure the price from 5 p.m. yesterday. I can't believe I didn't know that. $23,482 is the level we see on Bitcoin. I also want to just point out that we're seeing wheat and corn prices come down. We're expecting an agreement to be signed this morning, our time, I guess, this afternoon, now your time, Anna, to allow the export of grains from Ukraine through the Black Sea, and that should obviously take some pressure off prices here in Chicago. Kailey, what do you see in terms of pre-market movers?
Well, really, it's all about Snap this morning, Matt. Anna mentioned this, disappointing on revenue, the lack of advertising sales or the slowdown in online ad sales due to the weakening macroeconomic outlook really is what is weighing on the company here, as well as increased competition. The shares are absolutely tanking in early hours this morning. They were already down the better part of 70% year to date before the results. They're down another 29% in early hours. Absolutely brutal. And of course, there's not a great read through to other online advertising dependent companies, the likes of Twitter, which will be reporting at 8 a.m. Eastern, down about 2.5% at $38.55. They are still well below that $54.20 offer price from Elon Musk. And then, of course, we'll get results from Alphabet and Meta next week when all the mega caps report. They are both down as well in tandem with Snap, 4.5% for Meta, Alphabet down about 2.8%, Anna.
Let's have a look at where we are on European stocks then, Kailey. And European equity markets gaining, not feeling too much of the negativity around Snap. So stocks 600 is up by 0.5%. We've had weak data coming out through Europe, and that's certainly weighing on the euro, down by 0.8%. It's causing investors to go into fixed income. If you look at the GMM function on the Bloomberg, you can see a big green column under sovereign debt as investors are piling into that sovereign debt. And it doesn't necessarily look like the setup to more hiking here in Europe. Maybe that weakness in the data has got a lot of people thinking about just how many hikes we're going to see from the ECB. And of course, we don't have forward guidance anymore, so we don't know what to expect really for September. So that's what we're seeing on the euro and the fixed income markets. Uniper is in focus. This is a big gas player, the biggest gas buyer in Germany, and it called on the government for support after the Russians turned down the flow from Russia into Germany. It meant they had to go out into the spot market and purchase gas at very high levels. There's concern about contagion from this particular business into others. We expect to hear at the top of this hour, into the early part of next hour, from the German Chancellor about what they intend there in terms of the bailout, Matt.
All right, so let's get back to our guest right now, or to our guest. Ben Emons joins us, Medley Global Advisors Managing Director and Global Macro Strategist. So, Ben, in terms of what we saw, let's start in Europe, from the ECB yesterday. What do you make of the 50 basis point rate hike? And now it looks like we may see another 25 or 50 basis point rate hike. So going from 0 to 60 in, 24 hours.
Indeed, Matt, and I think it's a response to inflation. They just published the survey of professional forecasters too, and those inflation expectations really ratcheted up. So that information was probably in their hands yesterday, and again, amplifying that they have to raise rates quicker, and why they made this move yesterday, despite the early signal of the 25 basis points. But if I look at that guidance that you're getting this morning from one of the ECB governors, then that reminds me a lot of what the Fed is doing too. 25 or 50, we're data dependent. As data points come in, we can then make a choice whether we should go a little faster or stay at 25. So I think that's what the market is taking it today. Those yields are down really, I think, in response to PMI data, rather than what the ECB did yesterday. But it is a clear sign that the ECB has really made a U-turn, I think, in that way, ratcheting up rates, catching up with the Federal Reserve in that sense.
Yeah, Ben, good morning to you. But how long can the ECB hike for? When you look at the manufacturing data out of France suggesting contraction, the German manufacturing and services sectors now showing contraction in those PMIs, and with the threat of the gas taps being turned off, okay, they were turned back on, but could they go again? I mean, there's a lot of uncertainty for the Eurozone economy.
Undoubtedly, and I think this is what people are in the dark with. What is the reaction function of the ECB in a scenario where this mild contraction you're seeing now in the PMI data really becomes severe as this gas crisis does become worse? And that's something that we don't know yet. So I think the reaction in bond yields this morning is somewhat of a reflection of that. It seems to be all across the board. So peripherals and bonds doing the same move in yields. So that tells you that it's indeed a risk scenario that if the ECB ratchets up rates to catch up, yes, you have that risk of this double-edged sword, right? You're getting inflation not coming off that quick yet enough, and the growth contracts. So it is a risk for the Eurozone, no question.
There have been a lot of commodities in focus when it's come to inflation, Ben, in Europe and beyond. We've been focused a lot on grain prices, certainly in the early part of the Russian war in Ukraine. We were focused on the rising grain prices. They're coming off a little bit in expectation that we could get a deal. I mean, should we have high hopes or very modest hopes about what can be achieved between Ukraine and Russia as they try to free up the grain that is trapped in Ukraine right now? I mean, a demining activity, I assume, would take quite a long time.
Yeah, it does. I do think this agreement is quite relevant. It was picked up yesterday. I think this will start affecting markets really today, because if it does get to an agreement that's at least adhered to by Russia, because that's where the risk, of course, is that they back away from it again, then you're going to see more grain coming out of Ukraine faster, more. What we've seen so far is whatever has been exported is about a third or so of annually what they export, but through all kinds of routes that slow down the grain to where it needs to go to. So the futures market, as you see, reacts to this news now, and if you get more grain coming out of it, I would think that this would affect food price inflation in the next 2 months or so. That would be meaningful, I think, for financial markets.
Well, and it would be meaningful for the Federal Reserve that has told us they are reacting to headline inflation because that's what people feel, food and energy costs. So on that note, Ben, if we're starting to see a cooling of some of those pressures and a deterioration in the economic data, are you changing your view of where we'll ultimately get to on Fed funds?
It's certainly a challenge coming ahead of us, Kailey, because you're right, like this pressure on commodity prices seems to be now continuing. And we started mid-June with some caution. Now it seems to become more of a trend. So it will lead to ultimately, let's say, the pressure of headline inflation coming through. And as we know from guidance from the Fed, they want to see persistent decline for several months before they change the pace of tightening. That may start to happen then by September, right? As some of that data start to reflect that. So whether it will change the ultimate destination is not clear because the ultimate destination isn't clear. What's the right Fed funds rate to truly get inflation back to 2% target? The Ballard's view, it should be more like 3 7/8 type of a Fed funds rate. That's still priced in the market, even though commodity prices are going down.
Okay, well, of course, we'll get more clarity on what the Fed is thinking next week with that decision on Wednesday. But of course, that's going to come in the middle of a ton of market cap in the S&P 500 reporting. You have all the tech heavyweights due next week. Could be a huge catalyst for the market either way, Ben, especially off the back of Snap's results overnight. How optimistic are you feeling heading into a big week of earnings?
Well, so far, the earnings have surprised mostly to the upside. It's a tally of about 73% of reported. Now, that's not insignificant because if we were in a recession, then those earnings, we would also be in an earnings recession. We would have, let's say, less than 50% of companies surprising to the upside. That seems to be consistent with previous recession periods. So that's, I think, the good news. But the bad news, obviously, is that companies like Snap do show, and same with AT&T, shows what's going on with the consumer and where there's retrenchment happening as a result of high inflation and uncertainty. And we're seeing it from tentative layoff announcements through big tech as one example. So it's a huge week, and it's important for the markets because we have come off a bottom for tech. Are we going to see this through with the Nasdaq higher here? I think, given the environment we're in with alleviation of pressure on inflation and yields, that there's some more room. But those earnings will ultimately determine the direction of Nasdaq higher or lower.
Ben, thanks so much. Thanks for joining us. Ben Emons, Medley Global Advisors Managing Director, with us to talk about these markets. Excuse me. We'll continue to talk about the tech theme this morning. We'll discuss Snap's plunging sales with Rob Kniaz, who is from Hoxton Ventures, founding partner there and former Google product manager. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Well, social media giants across the board are plummeting this morning after Snap's disappointing revenue raised concerns about the outlook for online advertising. This, of course, comes ahead of Twitter earnings out before the bell today and Meta and Alphabet earnings due next week. Rob Kniaz, founding partner at Hoxton Ventures and a former Google product manager, joins us now for more. So all the stocks are down, but it's Snap getting absolutely brutalized, down some 28%. How much of this, Rob, is a Snap-specific problem versus a broader online advertising problem?
I mean, I think you have to assume this is going to be across the advertising industry, the online advertising industry. The worrisome thing, I think, for the industry overall is that Snap's numbers were actually up in terms of usage. So they're doing all the right things on the product side. The daily active user numbers were up about 18%. But earnings were flat quarter to quarter. So that says either consumers are buying less or advertisers focused on consumers are spending less. Either way, it's bad for the entire industry.
Are we seeing now real layoffs in this industry? I mean, I know we've seen hiring slowdowns or stories of planned hiring slowdowns for next year. Are you worried that they're going to really start to cut headcount?
It's definitely feasible. I mean, I think, for now, hiring freezes are the new layoffs that, for companies growing this much, they're constantly hiring. So not hiring means natural attrition leads to employee shrinkage. But I do think these companies have a lot of fat to cut. They've been profitable or making so much money the past decade that, they probably are overbuilt. So it wouldn't surprise me to see some layoffs happening.
What about CapEx? Are you concerned that they'll slow down investment?
Hard to say. I mean, I think, for companies like Alphabet and Microsoft and the more enterprise-focused ones, I think they still see a lot of investment as being crucial. For the consumer-focused companies, I think they're going to be certainly pulled in that direction by the markets to cut some of the capex a bit and or cut some of the employee compensation costs through stock. I think there's no way around it. In a tighter market, you have to economize some way or another.
In terms of the Snap story and how it relates to other advertising-reliant businesses, Rob, you mentioned how this could be coming from a number of different drivers. But I suppose, is TikTok competition, is that a big deal? And does that tell us something about which other big tech names should be hit by this news and will be hit by the same dynamics?
So it certainly is. But I think the interesting thing here is that because Snap was actually growing, they weren't losing users to TikTok. So to me, that says fundamentally it's just dollars in the door on the advertising side. That's the problem versus the actual users. If Snap was losing users, you could point to TikTok and say it's zero sum. People are going to TikTok. In this case, Snap isn't really losing people. It's actually gaining people, which means, simply put, the advertising dollars aren't coming over the door.
And looking ahead, we're looking for numbers from Twitter. What are you going to be looking for there? Clearly, they're up against some of the same themes we've already talked about, but they also add perhaps internal distraction from all of the headlines around Twitter recently.
Yeah, I think there's a real question, have they taken their eyes off the ball for the while? It's a company that's always been a bit shambolic. I think the current distraction with Elon Musk have certainly made people distracted inside the company for political and whatever reasons. So not only do they have a question of the market being soft potentially among their advertiser base, they also have internal disorder.
In terms of what we've seen in tech, we've seen the same or worse in crypto. Rob, how do you view this crypto winter? Is it something that we're going to come out of? I just asked because Tesla, has sold another 75%. We were reporting 75% of its Bitcoin holdings.
Yeah, I think it'll be rocky. I think all these things are intertwined. That for crypto, it comes down to users or consumers putting money into crypto, and that's been the big driver of growth over the past 4 or 5 years since it's been gone up especially high. I think same thing. If consumers are feeling less confident, are they going to have savings they can put into crypto? And then with crypto prices falling, it creates a negative cycle of people seeing their savings account effectively going down, and it makes them less excited to keep saving and or think about cashing out. So I think it'll be a rocky time for a while.
Rob, we're heading into a big week for tech earnings. We've talked about some that are coming sooner than that. But what about, and the ones we've already seen, but what about the ones next week? What is the standout question for you? Is it about advertising weakness? What are you looking for?
I think it's advertising weakness, and how much of it is consumer versus enterprise oriented. Companies like Alphabet have a lot more revenue they make from enterprise advertisers from the other tech companies selling software, among other things. So I do think part of the question is how much of this is isolated to the consumer side of the market and how much of it is broader ad tech overall.
Okay, thanks so much, Rob. Thanks for joining us. Rob Kniaz of Hoxton Ventures. Thanks for your insights. We'll continue to bring you all of the details around what's going on with tech. Next week, we get an absolute deluge of earnings globally. We referenced it there. Big names from tech, also from finance, oil, aviation and consumer goods report quarterly results. We'll bring you the latest news, analysis and market reaction. Let me just tell you some breaking news coming through from Uniper. We'll have more details of this shortly, but Germany will end up holding around a 30% stake in Uniper. This is the gas giant that has been seeking a government bailout in Germany. And KfW, which has been giving a financing line to Uniper, will increase that credit facility to €9 billion. More on that shortly. This is Bloomberg.
I don't think it's peaked yet, and our economists would say it's peaking. Probably is our team. Our team basically says that the Fed will continue to raise rates, and actually, Candace Browning-Platin's team, the research team at Bank of America, has the year-end recession, which they made a call on a few weeks ago. But it's a slight recession, and a recession is not accompanied by high unemployment, which means it ought to right itself and come back out. But it's more the impact of the Fed raising rates and slowing economy. So it's peaking is probably more appropriate than peak.
Bank of America Chairman and CEO Brian Moynihan speaking to Bloomberg, talking about the trajectory for inflation. Tom Keene joins us, co-anchor of Bloomberg Surveillance. And Tom, we've seen a lot of volatility in all kinds of asset classes of late, and that's got a few people asking why we're not seeing more fear in the so-called fear gauge. I think you wanted to talk about the VIX.
Into the weekend, the fact is it's a mini bull market. Off of the bottom, we're up 8-9%, 151% annualized off the middle of June. And I'm not saying it's a bull market, but the bears are sobered into the weekend. It's going to be very interesting to see the equity strategists writing. Here's a picture of it, the VIX. Going down is more optimistic. Going up is fear. The red line is that 40 statistic, Anna, which always indicates maximum fear, sweat. Ratings go up. Matt, loads a boat, triple margins up. Yellow is a more cautious 30, where we visited often recently. And down we go, nowhere near the 15 level that was the bliss pre-bear market. But nevertheless, it's been quite a 6 weeks.
It's amazing that the VIX is so low, given Snap, the story is really about a reduction in advertising spend. Plus, we've had all of these, not layoff stories, but hiring freeze stories. And then yesterday, the telephone story I thought was amazing. The stock dropped the most in 20 years after AT&T said people aren't paying their phone bills on time.
I wouldn't conflate them, Matt. I think you're absolutely right about AT&T, and that's just one of those data points that you wonder about. They've got their own challenges, particularly against what seems to be a superior business plan at T-Mobile. But I take great issue with conflating tech into one pie. Snap, if you look at Snap's financial statement, basically it's a fiction, Matt. There's no profit model for Snap. There never has been. And it's a story stock about revenue growth and the rest.
All right, very interesting stuff, Tom. Thanks so much for joining us. Look forward to your program. Tom Keene talking to us ahead of the original Bloomberg Surveillance coming up with normally John Farrow, Lisa Abramowitz. Kailey Leinz is doing double duty today. Let's take a look at some of the other stories we're watching. I am utterly confused by the Tesla story. The most recent scandal from the EV maker is that one of Elon Musk's lieutenants apparently was buying glass, possibly for him. And there's a problem with that. I don't know if it's the kind of glass he was buying, the way he was buying the glass, the purposes for which he was buying the glass, but it doesn't make a lot of sense to me. Nonetheless, there is apparently an internal investigation, according to people familiar, and I'll be following this to find out what the deal is, because maybe I want to buy glass, Anna. Maybe I want to buy you some glass.
So maybe the market is confused as well. Well, I already got glass. I did a big project in my house, had to wait a long time for glass. Anyway, that's of no interest to anybody. Let me tell you what's going on in the gas story here in Europe, because I'm watching this, Matt. We just got these headlines that say that, we got details really about the bailout of Uniper. This is the reaction in the Uniper share price. Remember, it was up earlier, but it's been down 75% year to date. So this has been a pretty destroyed stock up to this point. They called for a bailout from the government. They've got that. The German government will hold a 30% stake in Uniper post the capital raise. They're getting an increased credit facility. And it's interesting because Uniper is so connected, too connected to fail, it seems, Matt. And this is the one that the economy minister said if it fails, it could be a Lehman moment for the European economy.
Yeah, it could be very bad for an economy that's already looking at some tough times this winter.
Yeah, absolutely. So that's it for Early Edition. More surveillance is ahead. Tom Keene and the team will be back with you, taking you through the Friday edition of Surveillance. This is Bloomberg.